Everyone tells you New York is unaffordable. And for most of the state, they are right. The downstate market, the Metro Corridor, the Hudson Valley Premium Belt, those markets are exactly as expensive as the headlines suggest and getting harder to justify at current mortgage rates. But here is what the same people are not telling you. There is an entire geography of New York, hundreds of miles north of the 5 boroughs, where median home prices in specific towns sit below $100,000. Where the rental yield math still works for patient investors. Where structural demand is quietly building from remote workers, retirees, and institutional capital that has not yet fully arrived but whose leading indicators are already visible in the transaction data. That assumption about New York taxes? It is costing people a legitimate opportunity. The tax burden that makes New York synonymous with fiscal pain is real at the state level and devastating in specific high-assessed jurisdictions. But in the 10 upstate towns we are examining today, effective tax rates relative to purchase price tell a very different story than the state-level headline numbers suggest. A property assessed at $60,000 carries an annual tax bill that is structurally manageable in a way that the same rate applied to a $400,000 Long Island property is not. The story you have been told about New York real estate is accurate in one geography. In another, it is one of the most expensive misconceptions active in the current investment cycle. And I'm going to show you exactly where that misconception is costing investors who should be moving into these markets right now. The demand shift nobody is reporting. Before we get into the specific towns, there is a structural demand shift building in upstate New York that most of the national real estate conversation has completely missed. It is the same mechanism that repriced Pittsburgh a decade ago and Brooklyn 2 decades before that. I will show you exactly how it is operating in these specific markets. But hold that thread because the towns that benefit most from the shift are not the obvious ones. And the ones the mainstream will eventually identify are not necessarily the ones where the entry point advantage still exists today. The tax lie, what the numbers actually show. New York's reputation for punishing property taxes is built on a real foundation. The state consistently ranks at or near the top of national effective property tax rate comparisons. For homeowners in Nassau County, Westchester, and the high-assessed suburban corridors of the downstate region, the annual tax burden on a standard single-family home can exceed $10,000, $15,000, even $20,000 per year. Those numbers are real. They apply to those markets. They do not apply to the 10 towns on this list. Here is something most people completely overlook when evaluating upstate New York. Effective property tax rates are calculated as a percentage of assessed value. In markets where assessed values are low, the same nominal rate produces a dramatically lower dollar burden. A 2% effective rate on a $60,000 assessed value is $1,200 per year. On a $600,000 assessed value in a downstate suburb, the same rate is $12,000. Same state. Same rate. 10 times the dollar burden. The towns on this list have low assessed values because they have low market values. That is precisely the point. The entry price is low. The carrying cost is proportional to the entry price. And the income-to-cost ratio for buyers entering at these levels is fundamentally different from the calculation that makes downstate New York ownership financially punishing. The tax lie is not that New York taxes are low. They are not. The tax lie is the assumption that the state-level tax burden applies uniformly across every market in the state. It does not. And that assumption is actively preventing investors from correctly evaluating markets where the all-in carrying cost structure is considerably more favorable than the state-level narrative suggests. Pause. This changes the entire math for buyers who have been avoiding New York on tax grounds. There is one more dimension to the tax picture in upstate markets that deserves direct attention. Several of these towns fall within Opportunity Zone designations or qualify for the state's various agricultural and historic preservation tax credit programs. The effective tax position for an investor using available incentive structures in these markets can be substantially more favorable than the nominal rates suggest. Most buyers entering from outside the region are not working with local counsel who knows which incentives apply to which specific parcels. That information asymmetry is one of the primary reasons these markets remain underpriced relative to their actual carrying cost fundamentals. But the tax picture is only the entry point of this story. The more consequential question is what is actually driving demand into these markets right now, and whether that demand has the structural durability to sustain appreciation over a full investment cycle. That answer is more complex than the bears and the bulls are each suggesting. And it is where the real positioning intelligence lies. The demand architecture. Why these markets are moving now. Upstate New York's housing demand dynamics in the current cycle are being shaped by four distinct forces that are operating simultaneously and whose combined effect is considerably more powerful than any single factor would suggest. The first force is remote and hybrid work normalization. The pandemic-era migration into upstate markets from New York City and its suburbs introduced a buyer class that had not previously engaged with these markets. When remote work was fully permitted, the calculus was straightforward. Trade a 900-square-foot apartment in Brooklyn for a 3-bedroom house in the Catskills or the Hudson Valley Fringe for the same monthly cost or less. Many of those buyers discovered that the quality of life transaction was favorable enough to sustain even as return to office pressure increased. The hybrid worker who commutes to Manhattan 2 days per week can still live in a market 2 hours away and manage that commute with a combination of train and car access that the upstate rail and highway corridors provide. Here is the data point that most national coverage of this migration trend has missed. The buyers who moved to upstate New York during the peak of remote work adoption are not leaving at the rate that was predicted when return to office pressure intensified. Retention of pandemic-era transplants in markets like the Catskill Corridor, the Finger Lakes region, and the North Country has been higher than comparable Sun Belt markets where the migration was equally dramatic. The reason is switching cost. A household that has sold a downstate property, established community roots, enrolled children in schools, and built a local social network faces a significantly higher friction barrier to reversing that move than a household that was renting and simply relocated. The second force is the retirement migration corridor. New York has a substantial population of public sector retirees, teachers, municipal workers, and state employees whose pension income is tax-exempt at the state level. This cohort has been systematically underhoused in their retirement years because the markets where they spent their careers became unaffordable for fixed-income buyers. The upstate towns on this list represent the geographic corridor where this cohort can access homeownership at price points their pension income can sustain. The demand from this group is structural, consistent, and completely independent of mortgage rate cycles because a significant share of these buyers are transacting in cash from pension lump sums or downsizing equity. Here is what nobody tells you. The most durable demand in any housing market is the demand that does not depend on mortgage financing. Cash buyers set floors. The third force is the institutional capital scouting phase. This is where the Pittsburgh parallel I referenced at the start of this breakdown becomes directly relevant. In the years before Pittsburgh's housing market began its sustained appreciation cycle, institutional capital was visible in the transaction data of specific neighborhoods well before any mainstream narrative about Pittsburgh as a destination market had formed. Small and mid-sized investment firms, family offices, and regional operators were accumulating positions in specific zip codes while the national conversation still treated Pittsburgh as a Rust Belt cautionary tale. The appreciation that followed rewarded early movers disproportionately. In several of the upstate markets on this list, that early institutional scouting phase is now visible in the transaction data for anyone looking carefully. Acquisition volumes from out-of-state LLCs in markets like Kingston's Periphery, the Rome Corridor in Oneida County, and the southern tier around Binghamton have been rising over recent quarters. These are not large institutional buyers making headline acquisitions. They are the smaller sophisticated operators who move first and move quietly. The town that surprises everyone. There is one town on this list that will genuinely surprise most people watching this breakdown. It appears on no mainstream best markets list. It has been overlooked by virtually every national real estate publication covering upstate New York. And yet it has the strongest combination of our 5 demand indicators of any market in the region. I will identify it precisely and explain why it has been systematically overlooked when we get to the town rankings. Hold that thread. The fourth demand force is the one with the longest time horizon but potentially the largest total impact. It is the infrastructure investment cycle that is flowing into upstate New York through a combination of federal legislation and state economic development initiatives. The CHIPS Act semiconductor manufacturing investment in Onondaga County around Syracuse represents one of the largest single manufacturing investments in upstate New York's modern history. Micron Technology's commitment to build a semiconductor fabrication campus in Clay, New York, represents a potential $50 billion investment over the coming decade with a projected workforce of 9,000 direct employees and a substantially larger induced employment effect. The housing market implications for the greater Syracuse area and surrounding counties are not speculative. They are a function of basic supply and demand arithmetic. A major sustained influx of high-wage manufacturing employment into a market where current housing prices average well below national norms will produce a demand shock that current price levels do not reflect. You might think this is already priced in. That assumption is costing potential buyers a genuine entry point advantage. Semiconductor fab projects of this scale take years to complete. The workforce ramp is gradual. The housing market impact tends to arrive in waves over a 5 to 10-year period rather than immediately. Buyers entering before the first wave have historically captured the largest share of the resulting appreciation. The window for that entry point position in the Syracuse market and its surrounding counties is still open. It will not remain open indefinitely. Now that you understand the demand architecture driving these markets, the critical question becomes which specific towns have the combination of low entry price, improving demand fundamentals, and manageable carrying costs that produce genuine risk-adjusted opportunity. Some of the towns on this list are further along in the repricing cycle than others. And the one town that surprises everyone is coming up. That is exactly where we are going next. The 10 towns, ranked by opportunity profile. These 10 towns were identified through a systematic screening of upstate New York markets against 5 criteria. Median home price below $120,000, positive or stable population trajectory over the most recent measurement period, access to at least one of the 4 demand drivers identified above, a functioning local economy with at least one anchor employer or institutional demand source, and days on market trends showing compression rather than expansion. Town number 10, Olean, Cattaraugus County. Olean is one of the most overlooked small cities in western New York. Median home prices consistently sit below $70,000. The city anchors a small regional economy built around St. Bonaventure University, a regional hospital system, and manufacturing operations that have survived the broader deindustrialization that hollowed out comparable communities. University towns have a structural demand floor that pure residential markets lack. Students, faculty, and administrative staff create a rental demand base that insulates the market from the occupancy risk that affects more isolated rural markets. Town number 9, Salamanca, Cattaraugus County. Salamanca is the only city in the United States located entirely within a Native American reservation, occupying leased land within the Seneca Nation territory. This creates a unique ownership structure that most outside investors approach with caution, which is precisely why the market has remained underpriced relative to its fundamentals. The Seneca Nation's gaming operations in the region provide stable employment, and the lease renewal framework has been stable for decades. For buyers who understand the title structure and engage appropriate local counsel, the entry price relative to carrying cost ratio in Salamanca is among the most favorable in the entire state. Here is what most investors get wrong about non-standard ownership structures. The complexity is the discount. If it were simple, it would already be priced at fair value. Town number 8, Oswego, Oswego County. Oswego sits on Lake Ontario and is home to a State University of New York campus that provides a stable institutional demand base for the housing market. The city also sits in close proximity to the Micron semiconductor investment corridor around Syracuse, giving it secondary benefit from that demand wave without the direct price pressure that will eventually affect Clay and the immediate Syracuse suburbs. Median home prices remain below $80,000 in most of the city's residential neighborhoods. The university enrollment provides rental demand consistency, and the lakefront position creates a recreational amenity premium that similar inland markets at comparable price points cannot match. Town number 7, Rome, Oneida County. Rome is the upstate market where institutional scouting activity is most visible in the current transaction data. The city has a diversified employment base anchored by Griffis Business and Technology Park, which operates on the site of the former Griffis Air Force Base and houses a mix of defense contractors, technology companies, and research operations with federal contracts. Federal employment exposure creates income stability in local housing markets that is independent of private sector cycles. Rome's median home prices have been rising from a very low base but remain below $100,000 in significant portions of the residential market, creating entry points that have historically been associated with the early phase of appreciation cycles in comparable markets. Town number 6, Gloversville, Fulton County. Gloversville is one of the most interesting contrarian positions in upstate New York. The city was once the global center of leather glove manufacturing and experienced severe economic contraction as that industry declined. The consequence of that contraction is housing stock that is architecturally significant, historically dense, and priced at levels that reflect decades of economic depression rather than current market fundamentals. Gloversville is within commuting range of Schenectady and Albany, which provides access to the capital region's considerably stronger employment base. Buyers who can tolerate the rehabilitation investment required by older housing stock are finding entry prices that are functionally impossible in any market with comparable urban infrastructure density. This is what I was referring to earlier when I said the mechanism that repriced Pittsburgh is operating in upstate New York. Pittsburgh's Lawrenceville neighborhood had exactly this profile before it became one of the most discussed urban revitalization stories in American real estate. Architectural character, deep discount to replacement cost, access to a stronger adjacent employment market, and a buyer class willing to make the rehabilitation investment. Gloversville is not Lawrenceville, but the structural setup rhymes in ways that serious investors recognize. Town number 5. Plattsburgh, Clinton County. Plattsburgh sits on the western shore of Lake Champlain near the Canadian border and represents one of the most geographically distinctive markets on this list. The city benefits from cross-border demand. Canadian buyers seeking U.S. real estate exposure have historically been drawn to Plattsburgh's combination of accessibility and price, a State University of New York campus, and a regional medical center that provides stable high-wage employment. Median home prices have been rising but remain accessible. The Canadian buyer component provides a demand source that is completely independent of U.S. economic conditions, creating a structural buffer against pure domestic cycle exposure that most upstate markets lack. Town number 4. Binghamton, Broome County. Binghamton anchors the southern tier and has been one of the most persistently overlooked upstate markets despite a combination of fundamentals that would attract significant attention if they existed in a state with a less negative overall narrative. Binghamton University is a flagship SUNY campus with a research and engineering profile that has been attracting technology sector investment. Median home prices in the broader metro area remain dramatically below the national average. The challenge Binghamton faces is population decline that has been structural and sustained. The opportunity is that population decline at a citywide level does not prevent specific neighborhoods with strong employment proximity and housing quality from appreciating independently of the broader trend. This is where most investors get caught. They apply citywide metrics to neighborhood-level decisions. The submarket matters more than the metro average in declining population cities. Town number 3. Watertown, Jefferson County. Watertown's inclusion at number 3 reflects a specific and durable demand driver that most market observers underweight. Fort Drum, the U.S. Army installation near Watertown, is one of the largest military bases in the northeastern United States and home to the 10th Mountain Division. Military installations create housing demand that is recession-proof, federally funded, and independent of local economic conditions. The BAH, Basic Allowance for Housing, that military personnel receive creates a stable rent-paying cohort that functions as a demand floor for the surrounding housing market regardless of what is happening in the broader economy. Watertown's median home prices remain below national norms by a significant margin, and the military demand base provides a carry risk cushion that few civilian markets at comparable price points can match. Town number 2. Kingston, Ulster County. Kingston occupies a transitional position that puts it in a different category from the other markets on this list. It is not strictly speaking a dirt-cheap market anymore. The Hudson Valley migration wave that has been building over the past decade has pushed Kingston's median home prices above the threshold of the other towns on this list in desirable neighborhoods. But Kingston earns its number 2 position because of what it represents for the surrounding ring of communities in Ulster County that have not yet absorbed the same repricing. The towns in Kingston's orbit, Saugerties, Ellenville, the rural communities of the Catskill interior, remain priced at levels that reflect yesterday's narrative rather than today's demand reality. Kingston itself has become the proof of concept that the surrounding micromarkets are still waiting to price in. Buyers who understand that repricing tends to radiate outward from an established destination market have been positioning in Kingston's penumbra communities for precisely this reason. Town number 1, Utica, Oneida County. The town that surprises everyone. This is the town I referenced at the very beginning of this breakdown. Utica, a city that appears on virtually no mainstream best markets list. A city whose economic history includes the same deindustrialization narrative that affected most mid-sized northeastern cities. A city that, on a surface-level reading of its fundamentals, looks like exactly the kind of market that sophisticated investors are trained to avoid. And yet Utica currently has the strongest combination of forward-looking demand indicators of any market in upstate New York. The reason it surprises people is that most of those indicators are recent developments that have not yet been absorbed into the national narrative about the city. Here is what is actually happening in Utica right now. The city has become one of the most significant refugee resettlement communities in the United States, with one of the highest per capita refugee populations of any American city. This has created a dynamic that real estate analysts who focus exclusively on income demographics miss entirely. Refugee communities are among the most committed homebuyers in American real estate. Cultural values around home ownership, combined with the availability of specialized financing programs for refugee buyers, have produced transaction volumes in specific Utica neighborhoods that are dramatically above what the income demographics would predict. This is what I was building toward when I said there is a single underlying mechanism connecting the early institutional interest in these markets. It is the recognition that demand does not come only from high-income buyers with conventional financing. It comes from any cohort with sufficient financial discipline, access to appropriate financing structures, and strong cultural motivation to own rather than rent. Utica's refugee community is currently the most underappreciated source of sustainable housing demand in upstate New York. Median home prices in Utica remain below $60,000 in significant portions of the residential market. The city is within the Oneida County corridor that benefits from the Micron investment proximity. The SUNY Polytechnic campus provides an institutional anchor, and the refugee resettlement demand has been building for years without generating the kind of investor interest that equivalent demand signals in a Sun Belt market would immediately attract. The most valuable opportunities in any market are the ones where genuine demand is being systematically discounted because it does not fit the profile that most buyers are trained to recognize. Utica is a market that requires local knowledge, local relationships, and a willingness to engage with a buyer and renter pool that is culturally different from the transplant-driven demand stories that dominate national real estate media. For investors who can develop that operational competency, the entry price relative to yield and forward demand fundamentals is the strongest risk-adjusted opportunity currently visible in upstate New York. The risk scenarios. What can go wrong? Analytical credibility requires direct engagement with the downside scenarios. The 10 markets on this list are not without risk. Understanding that risk precisely is what separates informed positioning from naive optimism. The primary risk in most of these markets is what we can accurately call the liquidity trap. Entry prices are low, but exit liquidity, the ability to sell at a reasonable price in a reasonable time frame, is structurally constrained by the shallow buyer pools that characterize low-income, population declining markets. An investor who enters a Utica or Olean property at a $60,000 purchase price should underwrite the possibility that exiting that position in a shorter than expected time frame may require a price concession that represents a significant percentage of the original investment, even if the dollar magnitude of that concession is small. Here is the liquidity calculation that every investor in these markets must run honestly. If you needed to sell this property in 90 days, what price would clear the market? If that price represents a loss that your overall financial position cannot absorb without meaningful damage, your position sizing in this market is too large relative to your liquidity needs. Illiquid assets require illiquid capital. That discipline is non-negotiable regardless of how compelling the entry price appears. The second risk is the population trajectory trap. Several markets on this list are experiencing or have historically experienced net population outflow. Population decline is a structural headwind for housing demand that can persist for decades and can overwhelm even favorable micro-level demand drivers in specific years. The investor's task is to distinguish between city-wide population trends and neighborhood-level demand dynamics. The two are often diverging in these markets, with specific areas of genuine demand strength existing alongside broader demographic pressure. The distinction requires localized knowledge that remote investors frequently lack. The third risk is the infrastructure deterioration discount. Many upstate New York cities have aging infrastructure, deferred maintenance on public systems, and municipal fiscal constraints that limit the pace of improvement. Properties in these markets can face external physical environment deterioration that reduces desirability and value regardless of what is happening to the property itself. Due diligence in these markets requires an honest assessment of municipal fiscal health and infrastructure trajectory, not just the property's physical condition. The strategic framework. How to position in these markets. The positioning framework for these 10 markets has 4 components that apply regardless of which specific towns you are evaluating. The first component is entry price discipline. The low absolute price levels in these markets do not eliminate the importance of paying the right price. Overpaying for a $60,000 property is as financially damaging on a percentage basis as overpaying for a $600,000 property in a higher cost market. The comparative sales analysis in these markets requires access to local transaction data that national aggregator platforms frequently undercount or misattribute. Local county assessor records and direct MLS access through a local agent are the only reliable data sources for accurate comparable analysis in thin transaction markets. The second component is operational infrastructure. Low-cost markets require property management capacity that can handle the operational complexity of managing lower-income tenant relationships, older housing stock, and higher maintenance frequency than stabilized markets. The gross yield on a $60,000 rental property looks compelling. The net yield after accounting for vacancy, turnover, maintenance, and management overhead in a market with limited local contractor availability and constrained tenant income is considerably less so. Investors without established local operational infrastructure consistently underperform their underwriting in these markets. This is what I was pointing toward at the start of this breakdown when I said the entry price advantage in these markets is real but requires the right operational approach to monetize. The investors who have historically generated strong returns in comparable markets are not the ones with the most capital. They are the ones with the best local knowledge and the most disciplined operational approach. Capital without operational competency in thin markets is not an advantage. It is a liability. The third component is hold period calibration. These are not markets for investors with a 2 or 3 year exit horizon. The demand shifts we have identified are real, but they operate on a 5 to 10 year repricing timeline. An investor entering any of these markets should be underwriting a minimum 5-year hold period with adequate liquidity reserves to sustain that hold through periods of below projected performance. The Upstate New York appreciation cycle, if it follows the historical pattern of comparable market rehabilitations, will reward patience disproportionately. The fourth component is portfolio allocation discipline. The risk-adjusted return profile of these markets is compelling for investors who size their positions correctly. It becomes dangerous for investors who over-concentrate capital in a liquid, thin market assets because of the appeal of the entry price. A well-structured position in these markets represents a meaningful but not dominant share of a diversified portfolio. The illiquidity premium these markets offer is only valuable if your overall financial architecture can afford to keep the capital deployed for the full holding period. The closing. What the data is actually saying. New York's tax reputation is real. The fiscal challenges of the state are real. The population outflow from high-cost downstate markets is real. None of those realities negate what is happening in the 10 markets on this list. They contextualize it. The investors who conflate the state-level narrative with the market-level reality in upstate New York are making a category error that is creating mispricing they could be capitalizing on. Here is the final convergence of everything this breakdown has established. The 10 upstate towns on this list share a common characteristic that is more valuable than any individual market metric. They are priced on yesterday's story while being positioned at the leading edge of tomorrow's demand shift. That gap between story and reality is where investment returns come from. Not from buying into markets where the story is already fully priced, which is what every mainstream hot market recommendation amounts to, but from identifying markets where the fundamental improvement is real and measurable but the narrative has not yet caught up. The narrative about upstate New York will catch up. It always does. The infrastructure investment around Syracuse will generate coverage. The refugee-driven demand in Utica will eventually attract attention from national publications. The Hudson Valley overflow into Kingston's surrounding counties will eventually become part of the standard story about the region's transformation. By the time it does, the entry point advantage that exists today in these 10 towns will be a historical footnote rather than an actionable opportunity. The buyers and investors who recognized the gap between story and reality in Pittsburgh before the coverage arrived did not need the coverage to validate their decision. The transaction data validated it. The appreciation that followed confirmed it. The same data is available in upstate New York right now. The same gap between story and reality exists. The same window for positioning ahead of a repricing cycle is open. This is exactly where most investors get caught, waiting for the story to confirm what the data is already showing. The 10 towns on this list are not a guarantee. No market is. But they represent the clearest combination of low entry cost, building demand, manageable carrying structure, and forward appreciation potential currently visible in the northeastern United States. The tax lie that has kept investors away from upstate New York is real enough at the state level to be understandable. It is misleading enough at the market level to be costly. That distinction is the entire opportunity.